Hi everybody, and welcome back to video number 2 in chapter 20. And when we left off, we were looking at first, I'll go back, we were looking at this production budget and how it was calculated. Now that we know how much we're going to make, we need to break that down into its pieces. And the first piece is computing the materials to be purchased. So the materials to be purchased here and the units that we're going to produce, we're going to find out how many units we're going to produce. We can get that from our prior slide here. And now we need to know how many pieces of material are required per unit. And then we'll add in the desired ending materials inventory and back out the beginning materials inventory. Okay, so how do we do that? Here's our units to be produced. We just did that slide. And here we're using 1/2 pound of material per unit. So the materials that we need to purchase in pounds are 355 pounds, 670 pounds, 475 pounds. And we want to have a desired ending inventory to be 50% of the next month's materials needed for production. So we take half of 670 in this example, and that gives us 335 pounds of inventory that we want in our ending inventory. We add that to the materials needed for production, and that gives us the total materials required in pounds. We already have beginning materials of 178 pounds in October, and that gives us the number of pounds we need to purchase. So in this case, we have 512 pounds, 572.5 pounds for November, and 485 pounds for December. It costs $20 per pound, so then we can multiply that through to get the cost of the direct material purchases here. Okay. Now, the next piece is going to be direct labor, and that's going to be, again, based on the production budget and expressed in costs. So the cost of direct labor, we're going to take the units to produce, multiply that by the direct labor hours required per unit, and then multiply that times the direct labor cost per hour. Okay, that's a little more convoluted, but I think you get the idea. Here is an example of that. The direct labor budget's going to show the budgeted cost for the direct labor that's going to be needed to satisfy the estimated production for the period. So here's our units to produce again, and it takes 15 minutes or a quarter of an hour per unit. So that we multiply that through, we get the direct labor hours that we need here and here. Now, what we do next is we multiply that times the direct labor cost per hour. And in this example, that's $12 per hour. And we multiply that through times the direct labor hours needed. And that gives us the cost of direct labor. Here, here, and here. Okay. So the factory overhead budget, that's going to show the budgeted costs for factory overhead that are needed to complete the estimated production for the period. So again, we know the direct labor hours that we need here, and we know the variable overhead rate per direct labor hour. In this example, $10. And so we can calculate the budgeted variable overhead here plus the budgeted fixed overhead here. And that gives us the total budgeted total factory overhead here and here. So the variable portion of factory overhead is assigned at a rate of $2.50 per unit of production. So that $2.50, as I think you can see, is going to take this $10 and divide it by 4 because our labor is a quarter of an hour per unit. And then the fixed overhead is $1,500 per month. Okay, now we can compute our product cost per unit. And TSCs, who is our manufacturer in this case, can compute the product cost per unit from these 3 manufacturing budgets. So for budgeting purposes, TSC assumes that we'll normally produce 3,000 units of product each quarter. And that's going to yield fixed overhead of $1.50 per unit. TSC's other product costs are all variable. So here we're going to look at the budgeted product cost. The direct materials, that was a half a pound of materials per unit at $20 per pound. That's going to give us $10 of direct materials per unit, which we just calculated. Direct labor was a quarter of an hour of direct labor times $12 per hour, or $3 per unit. Variable overhead was 25 cents, that's the direct labor hour, times the $10 variable cost per hour, or $2.50. And the fixed overhead of $1,500 per month, we're going to divide that by 1,000 units of expected production per month, or $1.50. Okay, and that will total $17. I think they've got a little glitch in the PowerPoint here in that it will normally produce 3,000 units of product each quarter. Don't get that confused. As I say, that's 1,000 units per month times 3 to get the 3,000 units. Okay, so the total product cost per unit then is $17. Now the cost of goods sold budget is important, therefore, in preparing the budgeted income statement. So here we're going to take the budgeted units times the product cost per unit, and that'll give us our budgeted cost of goods sold. So here was our budgeted sales units, here, and then our budgeted cost per unit was $17. Therefore, we can compute the budgeted cost of goods sold at $17,000 for October, $13,600 for November, and $23,800 for December, totaling $54,400 for the quarter. Okay, selling expense. 2 pieces to the selling expense. We have sales commissions, and we have a fixed salary for the sales manager. So our budgeted sales was $60,000 for October, $48,000 for November, $84,000 for December, and the commission is 10%. So we can calculate sales commissions of $6,000, $4,800, and $8,400, total for the quarter of $19,200. But the salary for the sales manager is fixed. So at $2,000 per month. And so we add the two together and we get our total selling expenses for the quarter of $25,200. All right. And so to review, the sales commissions were 10% of total sales, and the monthly salary of its sales manager was $2,000. Okay, general and administrative. Toronto Sticks Company, TSC, has general and administrative salaries of $54,000 per year or $4,500 per month. All of the G&A in this company are fixed. So we can just lay those little beauties into each month for a total of $13,500 for the quarter. And that comprises all of the total G&A, general and administrative expenses. Okay, let's take a look at preparing the cash budget for a manufacturing company. Now, we need to put all of these pieces together, which is, in the real world, quite involved. And in academia, it's a little involved too. So let's take a look at that. The capital expenditures budget reports expected cash receipts and payment related to the sale and purchase of plant assets. So here they're saying, I need to purchase a piece of equipment in December for $25,000. So my total capital expenditures for the quarter is $25,000. So then the next step then is to prepare the cash budget, which shows the budgeted cash receipts and cash payments during the budget period. We call this the financing budget. And so the general formula for a cash budget starts with the beginning cash balance. And to that, we're going to add the budgeted cash receipts, subtract out the budgeted cash payments, and that will give us a preliminary cash budget. Now, if we are above the minimum that we want in our preliminary cash budget and have a little extra money, we can repay some of our loans. However, if we're below where we want to be as our minimum, we would have to increase our bank loans. And after that has been computed, we would have our ending cash balance. All right, so here's our sales for September, October, November, and December. And how do we receive our cash receipts? We get 40% of the current month's sales in that month. So I'm going to take, in this case, 40% of $60,000 to get $24,000. But I also need to collect from the prior month. So I'm going to get 60% of September's sales dollars here. And that gives me a total of $49,200. I do that same calculation for the remaining months of the quarter. And I now can forecast my total cash receipts for the quarter that way. So again, cash sales are 40% of each month's sales. Accounts receivable balance at the end of each month is 60% of that month's budgeted sales that we collect in that month. Okay. You can see why they're showing this with Excel. All right. That looks like a good place to stop this video. And when we return, we'll take a look at budgeted cash receipts and the timing thereof. Until that time, bye for now.